Welcome to the deep dive. No calculators necessary today. We're going all in on accounting. We've got a stack of study guides. And you know what? This isn't about memorizing formulas. It's about the logic, like the why behind how businesses stay on top of their money stuff.
Exactly. We're going to break down all those accounting principles that seem, I don't know, kind of complex and show how they play out in the real world. It's like learning, a whole new language.
Okay, I like that. The language of business. So this first chapter, this is like setting the stage, right? Laying the foundation.
Yeah. It all starts with getting that financial information right for decision making. Basically painting a clear picture of how the business is doing money-wise so investors, lenders, even the owners themselves can make smart choices.
Like a financial GPS guiding them to success, right?
Exactly. And you can't forget about the accounting equation. It's like the bedrock, the foundation of the whole system.
The accounting equation, huh?
Yeah.
Okay, break that down for me.
It's it's simple, but powerful. Assets equal liabilities plus equity.
All right, so what exactly are we talking about here? Assets, liabilities, equity.
Think of it this way. Assets, those are what a business owns. Stuff like cash, inventory, equipment, even things you can't really touch, like patents or trademarks. Liabilities, that's what the business owes. Loans, bills, that kind of thing. And equity. That's the owner's piece of the pie, their investment, plus any profits they've kept in the business.
So it's a balancing act. You got to own as much as you owe and have invested earned.
You got it. And that equation, that's the foundation for everything else in accounting.
So the document also talks about different types of accounting. Financial accounting and then management accounting. Are these like two sides of the same coin?
You could say that. Financial accounting, that's like the public face of the business's money situation. The info they share, with the outside world through reports, stuff like the income statement, balance sheet, statement of cash flows. It's all about following specific rules to keep things consistent and transparent.
Okay, so it's like the official record, the one they use to talk to investors and lenders and regulators.
Exactly. Now, management accounting, that's more behind the scenes. This is about giving info to the people running the show, the managers. Reports and analysis that help them plan, control, keep things running smoothly, like budgeting, cost analysis, performance reporting.
So financial accounting is for the outside world, and management accounting is the internal compass.
Exactly. They both use those same core accounting principles, but serve different purposes.
Makes sense. So this chapter, it really highlights that understanding the purpose and users of accounting information is key to understanding the bigger picture.
Absolutely. Accounting isn't just about, crunching numbers. It's about giving valuable insights to make better decisions.
Okay, so the document mentions this double entry system. What is that exactly? Sounds kind of mysterious.
Well, it's a fundamental principle in accounting, the way we record transactions. Every entry has two sides, a debit and a credit.
Like a financial seesaw to keep everything balanced.
Yeah, like that. So debits, they increase assets or expenses. And credits increase liabilities, equity, or revenue. Let's say a business buys a new piece of equipment. That would be a debit to the asset account because the asset increased, and then a credit to either cash if they paid cash or accounts payable if they bought it on credit.
I'm starting to see how this works. Every move a business makes gets recorded twice, once as a debit, once as a credit, to keep things balanced. Why is this so important?
Well, it's all about accuracy and preventing errors. Recording every transaction twice creates the system of checks and balances, helps businesses keep track of their finances and make sure nothing falls through the cracks.
It's a built-in error detection system for their books?
Yeah. And the double entry system, that's how we get those financial statements we were talking about before.
It's all connected, like the engine that drives the whole accounting machine. And this chapter really hammers this concept home because it underpins everything else.
It's the foundation upon which the entire system of financial reporting is built.
This is already making me look at my own finances differently.
Even for personal finances, it's valuable. Understanding accounting basics can help with making decisions about your own money.
Speaking of decisions, the chapter also talks about ethical behavior in accounting. How does that fit in?
Well, think about it. Accounting professionals, they're dealing with sensitive information, right? Financial stuff, and they have to make sure financial reporting is accurate and reliable. Ethical behavior builds trust and confidence in the whole system.
So it's not just following the rules, it's acting with integrity.
Exactly. Ethics, they're at the very core of the accounting profession.
This deep dive making me realize how much I don't know about how my finances actually work. But let's move on. This next chapter, it's getting into measuring financial performance. Are we making money or not?
That's where income and expenses come in. Income is, well, it's the inflow of economic benefits, the money a business makes from selling stuff or services. Expenses, that's the outflow, the costs of doing business.
Pretty simple, right? More income, good. More expenses, not so good. Basically, the document makes it clear. The difference between income and expenses, that's the profit or loss, the ultimate measure of success.
So more income than expenses. That's how a business stays in the black. And this chapter breaks down all the different types of income and expenses they might run into.
Absolutely. Income, it's categorized into sales revenue, service revenue, investment income, and then there are the expenses like cost of goods sold, salaries, rent, utilities, marketing expenses, you name it. Understanding these categories, that's crucial for tracking financial performance accurately.
Like sorting through all the financial ingredients to see what makes a profit or loss.
I like that. Each income and expense item contributes to the big picture.
So to keep track of all these transactions, the income, the expenses, buying, selling, businesses need a system, right? What does the document say about that?
Source documents, that's the key. They're the evidence, the proof of those financial transactions. Think invoices, receipts, purchase orders, bank statements, anything like that.
Like a paper trail. Or a digital one these days. Exactly. Source documents, they're super important for keeping accurate records, making sure every transaction can be traced back to where it started.
This is reminding me of that game show where you have to, balance those weights perfectly to win the prize. Except in accounting, it's about balancing those debits and credits.
I love that analogy, finding that equilibrium, that balance between what a company owns and what it owes.
Now we're getting practical. This next chapter is all about journals and ledgers.
Yep.
These are like the tools of the accounting trade.
You got it. Organized systems businesses use to record and classify all those transactions. Journals, those are the first entry points. Transactions get recorded, like in a diary, in the order they happen. Ledgers take that info and organize it by account. Cash, inventory, accounts payable.
So it's a multi-step process from journals to ledgers to make a complete and accurate record.
Right. The document gives all these examples of different journals, cash receipts, cash payments, sales, purchases, each one for a specific kind of transaction. And it explains how each transaction is recorded, using that double entry system, always keeping debits and credits balanced.
This all builds towards those key financial statements, right?
Absolutely. And the next section, that dives deep into those. The statement of financial position, also known as the balance sheet, the statement of profit or loss or income statement, and the statement of changes in equity. It's like putting the puzzle pieces together to see the full financial picture.
This document, it really shows how important the basics are. The different accounts, the double entry system, all the different journals and ledgers, it's all connected.
And that connection, that's what makes accounting so powerful. It lets businesses track their progress, make informed decisions, and reach their financial goals. By the way, things get even more practical in the next part of our deep dive.
I'm ready for it. Already feeling more confident about navigating the financial world. But for now, we'll take a little break. Join us for part 2 as we keep exploring the world of accounting.
Welcome back to our deep dive into the world of accounting.
All right, so last time we really got into the details of recording transactions, and we even started touching on those important financial statements. Ready to dive deeper into those? Where do we start?
This chapter's all about one of the most important financial statements, the statement of financial position. You might know it as the balance sheet. It's like a snapshot of a business's financial health at a specific moment.
I like that. A snapshot. A frozen moment in time.
Yeah.
Showing what they own, what they owe, the owner's stake.
Exactly. It follows that accounting equation we talked about before. Assets equals liabilities plus equity. So it lists all the assets on one side and all the liabilities and equity on the other.
Got to make sure everything balances out, right? Both sides of the equation. So when we're talking assets, what are we really looking at?
Well, we categorize assets into two main types, current assets and non-current assets. Current assets are things that are expected to be turned into cash or used up within a year. Things like cash, accounts receivable, and inventory.
Okay, so those are the things that are constantly moving.
Yeah.
In and out of the business.
Right. Non-current assets, those are expected to provide benefits for more than 1 year. Think property, plant, equipment, intangible assets, long-term investments.
Got it. So it's like separating the short-term stuff from the long-term stuff. What about liabilities? Do they work the same way?
Yeah, similar idea. Current liabilities and non-current liabilities. Current liabilities, those have to be paid within a year. Things like accounts payable, salaries payable, short-term loans.
Okay, so like bills that need to be paid pretty soon. And non-current liabilities, those are the long-term ones.
Exactly, due to be paid over a longer period, more than a year. Mortgages, bonds payable, long-term leases, things like that.
Okay, all about knowing when those payments are coming due. And then, of course, we have equity. That's the owner's stake.
Right. Equity, it includes the owner's initial investment, any more money they put in later on, and the accumulated profits, or losses, of the business that have been kept in the business.
So the statement of financial position, it gives us that overview of all the elements, assets, liabilities, equity, really gives a clear picture of their financial health. What can we actually learn from analyzing it?
Oh, it can tell you a lot about a business's liquidity, solvency, overall financial stability. For example, if you compare current assets to current liabilities, that gives you an idea of their ability to meet their short-term obligations.
Like, do they have enough cash on hand to pay their bills?
Exactly. And looking at the mix of assets and liabilities can help you assess their long-term health, their ability to generate profits and pay off their debts.
This is making me think about how important it is to really understand these statements. They're not just numbers, they're telling a story.
That's a great way to put it. Financial statements, they're powerful tools for understanding a business's financial performance and position.
Okay, so moving from the balance sheet to the statement of profit or loss, which is sometimes called the income statement, what's the focus here?
The statement of profit or loss, it reports on the financial performance over a specific period. Could be a month, a quarter, a year, shows how much revenue they brought in, how much they spent, and of course, whether they made a profit or had a loss.
The bottom line, right? The results of their operations. So what are the key things we're looking at in this statement?
It starts with revenue, then you subtract the cost of goods sold, which gives you the gross profit. From there, you deduct operating expenses. That gets you to operating profit. Finally, you factor in any other income or expenses, like interest income, tax expense, to arrive at the net profit or loss.
Okay, a lot of terms there. What's revenue exactly?
Revenue is the money coming in from the core operations. For a retail store, that's the sales from selling goods. For a service business, it's the fees they earn for their services.
So it's the money they make from their main activities.
Exactly. And the cost of goods sold. That's all the direct costs tied to producing or getting the goods that were sold. For manufacturers, this includes things like raw materials, labor, manufacturing overhead. For retailers, it's the cost of buying those goods from their suppliers.
The cost of the stuff that was sold to generate the revenue.
Right. And then we have gross profit. That's the difference between the revenue and the cost of goods sold. Basically, the profit from the core operations before considering other expenses.
It's the first level of profitability, how much they actually made from selling those products or services.
Exactly. And then we subtract operating expenses. Things like salaries, rent, utilities, marketing, administrative costs, basically the costs of running the business.
Okay, so those are the costs to keep the lights on and everything running smoothly. And after those, we get to operating profit.
Right. Operating profit is the profit from the core operations after deducting all those operating expenses. It shows how efficient and profitable the business is.
So the profit from the main activities before considering any other income or expenses. What's next?
Then we factor in any other income or expenses. Things like interest income, interest expense, gains or losses from selling assets, and tax expense. That gets us to the final figure on the statement, the net profit or loss.
So the net profit or loss, that's the bottom line, right? Tells us if the business made money or not after everything is accounted for.
You got it. Financial statements, they're like pieces of a puzzle. Put them together, and they reveal a picture of the business's financial health and performance.
Speaking of puzzle pieces, this next chapter is all about inventory. The goods businesses buy or make to sell.
Yeah, this is where we get into inventory accounting. It can get pretty detailed, but the main idea is to track the flow of inventory accurately, from when it's purchased or produced to when it's sold.
Okay, so knowing what's in stock, what's been sold, and how much it cost.
Exactly. There are two ways to account for inventory, the perpetual system and the periodic system.
So businesses can pick which method works best for them. What's the difference?
A perpetual inventory system, it tracks inventory levels constantly. Every purchase, every sale, it's recorded in real time. They always know exactly how much they have. It's like a really sophisticated tracking system.
Sounds high-tech.
It is. Now, a periodic system, that relies on physical counts of the inventory. done at specific times, could be monthly, could be quarterly. They're not tracking every single buy and sell. They just count their inventory periodically to see how much they have.
So more of a manual process. What are the good and bad things about each system?
Well, perpetual, it gives you more accurate, up-to-date information, important for businesses with valuable inventory or those that need to manage their stock really closely, but it can be more complex and expensive to set up.
So there's a trade-off, accuracy versus cost. What about periodic?
Periodic is simpler and less expensive to implement, but it might not be as accurate because it relies on those periodic physical counts.
Seems like the right system really depends on the business and what they need.
You got it. And this chapter looks at all sorts of factors to consider when picking a system. The kind of inventory, how many transactions, how much control they need over their stock level.
Wow. There are a lot of decisions to make when setting up accounting systems.
Absolutely. But having a good system is, well, it's essential for success.
Now, this next chapter brings us back to the double entry system. But this time we're talking about adjusting entries.
Right, adjusting entries. A crucial part of accounting. We make these at the end of the accounting period to make sure those financial statements are accurate.
It's like fine-tuning the books to make sure everything is in the right place.
Exactly. Adjusting entries are needed because sometimes transactions aren't completely captured as they happen. They might span over multiple periods, or they might involve estimates or accruals.
Okay, can you give me an example? I'm having a hard time picturing what these adjusting entries would look like.
Sure. Imagine a business that pays their employees every 2 weeks. At the end of the month, there might be some unpaid wages that need to be recorded as an expense, even though they haven't been paid yet.
Okay. So it's like acknowledging that those wages have been earned, even if the money hasn't gone out yet.
Precisely. Or think about depreciation. We talked about it before, but it's a good example here.
Yeah, depreciation, that's accounting for the wear and tear on assets.
Yeah.
How does that tie into adjusting entries?
So at the end of every accounting period, businesses need to make an adjusting entry to record how much of the asset's cost has been used up during that time. So the asset's value is accurately reflected on the balance sheet, and the depreciation expense is on the income statement.
Like spreading the cost of the asset over its useful life.
Yeah.
So what other kinds of adjusting entries might be needed?
Well, there are a bunch. Accrued revenues, that's revenue earned but not received yet. Prepaid expenses, expenses paid in advance but haven't been used. Unearned revenues, revenues received in advance but not earned yet. Accrued expenses, expenses incurred but not paid.
This is a lot. It sounds like these adjusting entries are really important for making sure the financial statements give a true picture of how the business is doing.
Absolutely. They're a key part of the accounting cycle, a fundamental concept for understanding financial reporting.
This deep dive is showing me just how much work goes into managing finances for a business.
Yeah.
It's not just recording things, it's making sure everything's accounted for accurately, and that those statements reflect the real economic situation of the business.
You're exactly right. Accounting, it's more than just numbers. It's about understanding the story those numbers tell and using that information to make smart choices. And speaking of stories, we're going to look at some interesting real-world examples in the next part of our deep dive.
Can't wait. This is making me think about all the financial decisions I make in my own life and how understanding accounting can help. But for now, we'll take a break. Join us for part 3 as we continue to unlock the secrets of accounting. Back again for the deep dive. Last time, we were all about adjusting entries, like fine-tuning the books for accuracy. I'm ready for more. What's up next?
So we've got those core financial statements down. We understand the adjusting process. Now this chapter, it takes us to, well, accounting for different kinds of businesses, applying those principles we've learned, in different settings.
Okay, so it's like taking our accounting toolkit and using it in different industries, different business models.
Yeah, that's a good way to put it. This chapter zeroes in on service businesses and merchandising businesses.
I think I get the general idea, but refresh my memory. What are the key differences again?
Sure. Service businesses, they're all about providing services to their customers. Doctors, lawyers, consultants, hair salons, they're selling their expertise, their time. Merchandising businesses, they make money by buying and selling goods. Think retail stores, wholesalers, online shops. They're all about moving products.
Got it. Service businesses, skills, merchandising businesses, products. How does that change their accounting?
The big difference is in how they account for their costs. Service businesses, they don't have to worry about inventory because they're not dealing with physical goods. Their main costs are usually salaries, rent, other operating expenses. Merchandising businesses, though, they have to keep a close eye on their inventory. It's a big chunk of their costs.
Right. They need to know how much they're spending to get those goods and how much they're making when they sell them.
Exactly. In this chapter, it goes into the specifics of how merchandising businesses handle their accounting, recording purchases, sales, returns, discounts, all that. Also, different ways to value inventory, like FIFO, first in, first out, and weighted average cost.
So there's a whole extra layer of accounting when you're dealing with inventory. What about service businesses? Is it simpler for them?
In some ways, yeah.
Yeah.
No inventory to worry about. But they still need to carefully track their revenue and expenses to make sure they're making a profit. This chapter emphasizes that accurate revenue recognition is key for service businesses, especially when those services are provided over a period of time.
You got to make sure you're recognizing the revenue when it's earned, not just when you get the cash. This shows how accounting principles can be applied differently based on the business type.
You got it. Accounting, it's flexible, adaptable. It can be used in different industries, different business models.
Now, this next chapter gets into something that can be a little intimidating. Cash flow.
Yes.
What makes it so important, and what do we need to understand about it?
Cash flow, it's like the lifeblood of a business. You can be profitable on paper, but if you don't have enough cash coming in to pay your bills, well, you won't stay afloat. This chapter stresses managing cash flow, making sure there's enough liquidity to meet those short-term obligations and, invest for future growth.
So it's not just about making a profit, it's about having enough cash on hand to keep everything running.
Exactly. And this chapter introduces a really useful tool for analyzing cash flow, the statement of cash flows. It tracks all the cash coming in and going out over a specific period.
Like a financial GPS, showing where the cash is coming from and where it's going.
Perfect analogy. The statement of cash flows, it breaks things down into three main activities: operating activities, investing activities, and financing activities.
All right, let's break it down. What are operating activities?
Operating activities, those are the day-to-day things the business does. The core activities that make money and incur expenses. Cash from customers, cash paid to suppliers, salaries, that sort of thing.
Got it. The cash flow from running the business, basically. What about investing activities?
Investing activities, those are about buying and selling long-term assets. Like if they spend money on property, plant, and equipment, or get cash from selling those assets.
So the cash flow tied to those big-ticket items that help generate revenue over time.
Exactly. And then there's financing activities.
What falls into that category?
Financing activities, that's about getting money and paying it back. Cash from issuing stock or bonds, cash paid out as dividends, cash used to pay off loans.
Okay, so how the business is funding everything, their operations and investments. This helps understand the different ways they use and get cash.
You're getting it. The statement of cash flows gives a lot of insight into a business's liquidity, how well they generate cash from operations, and their financing strategies.
Cash flow analysis, it's a crucial skill for anyone involved in business.
Absolutely. Understanding cash flow is essential for making good financial decisions, making sure a business can last in the long run.
This deep dive has been incredible, a real journey through accounting. We started with that fundamental equation, and now we're talking about all the complexities of cash flow.
I agree. We've explored those core principles, learned how to analyze financial statements, even looked at different business types.
I feel much more confident about, dealing with the financial world now. And I have to say, I'm surprised by how interesting accounting actually is.
It's been great exploring this with you. Remember, accounting is more than just numbers. It's a powerful tool for understanding a business's financial health, using that information to make good decisions that lead to success.
Well said. Till next time on The Deep Dive, happy accounting.